Well, the One Big Beautiful Bill Act made a ton of changes to the tax code for this year, the biggest since 2017's Tax Cuts and Job Act. Now, we've made a lot of videos doing some deep dives into some of the provisions that affect individuals and business owners. But today we're going to do more of a rapid fire. I want to give you 10 things that the One Big Beautiful Bill Act changes in the tax code, how it affects you, and some small things that you can do to plan for the future so that you can save on taxes for yourself or your business. Now, I'm Dave Lewis. I'm a certified public accountant and the owner of High Impact CPA. We're a full service accounting and tax firm that helps small business owners save on taxes and improve their profitability and cash flows. So, just a quick disclaimer to get this out of the way. This is not meant to be tax advice. This is educational only. Um, Please work with your tax professional to make sure that you are applying these provisions in ways that are going to be most beneficial to you. All right, let's jump right on in here. These are 10 things that the One Big Beautiful Bill Act changes that may affect you, may not affect you, but you should be aware of them. First thing, let's talk about Section 199A. This is the pass-through QBI deduction, 20% QBI deduction, excuse me. So what is it at a very high level? So sole proprietors, businesses taxed as partnerships, and businesses taxed as S corporations keep up to 20% deduction on their qualified business income going forward. Now, this was set to expire after 2025. This has now been made permanent by the provisions of the Act. So that permanence makes long-range planning a lot easier and reduces some of the whiplash from the changing rules. It's not automatic, though. The benefit can shrink at higher incomes, so there's a phase out, and it depends on things like how much your company pays in W-2 wages and how much qualified property that it holds. So who does this affect most? I mean, owners with profitable pass-through businesses. So if you're a partner in a partnership or a shareholder in an S corp, this is going to affect you, and even my sole proprietors who are filing on Schedule C. This applies to you as well. Also, high income service businesses still face limitations. So there was an extra threshold for specified service trade businesses, SSTBs, and so they had more of a limitation. That's been expanded a little bit. And we can go into that in a deeper video that'll be at a future date. But for now, let's just talk at high level. There's some key thresholds that you need to know. The deduction phases down at higher income levels and is again influenced by your W-2 wages and property. Those specific dollar amounts are going to update each year. Simple planning idea you can take with this, take to your tax advisor, have them review the balance between your owner payroll versus distributions and your entity structure. So, for example, if you're an S Corp and you have to take a reasonable salary, it might be worth looking at what that number actually means again. One, making sure you're actually having a reasonable salary for your S Corp, but it might be worth increasing that if it means that the savings you're going to get from the QBI deduction are going to exceed the self-employment tax savings you would get from taking more distributions rather than having a salary. So just something you can run the numbers with to see if it's going to work for you. The next biggest thing, and we've made a video on this in the past, go look it up. It dives a little deeper. Bonus depreciation is now permanent. So it's back what it is. So if you're a business that buys assets like machinery, computers, vehicles, interior improvements, these can be written off 100% again in the year that they're placed in service. So that's like getting a big coupon there you buy instead of having to depreciate it over time. So, smaller deductions each year. So that can accelerate your cash flow forward that you can reinvest into the business or elsewhere. So who it affects most? Capital intensive businesses such as manufacturing, construction, logistics, or any company that's going through and refreshing their equipment. So some thresholds to know. To get the 100%, assets generally need to be acquired and placed into service after January 19th, 2025 with binding contracts on or after that date. So if you entered into a contract before that date, you are not going to be able to take advantage of this. Essentially, you said, I'm going to buy this asset or intended to buy this asset before the new president got into office of this year. So that's that fun little political spin on the January 19th date. Um, the Section 190, 179 expensing limits have also risen, with a cap around the low $2 million range and a phase out beginning around the $4 million range. So if you're putting a lot of new equipment into the business or buying used equipment, it's important to look at how much you're putting in each year and making sure we're staying abreast of those thresholds. The other important thing to note with this is that bonus depreciation can create a loss in your business. So you can use that to offset against other active income with other businesses. So here's a simple planning idea. Make an A/B testing list. Things you can place into service this year versus next year, and anything that you can order before your tax return cutoff date. So for most people, that'll be December 31st. Confirm whether it still qualifies for the bonus depreciation and see what that is going to do for your cash flow. So good tax strategist is going to be able to put that together for you. Third item, business interest limit. The calculation is now friendly again. So what does that mean? The cap on how much interest a business can deduct switches back to being based on EBITDA. So earnings before interest, taxes, depreciation, and amortization, rather than just EBIT, interest before interest and taxes. So that usually means you're going to be able to deduct more interest than under the recent stricter version. So if you're a very leveraged company or you're growing really fast and you're taking on a lot of debt, it's probably time to look at that structure again and see how much more interest you can deduct. This may also very well affect your cost of capital calculations. So if you're looking to raise capital through equity or debt, it might be time to look at that structure again to see if the debt's a little more advantageous with that tax effect. Fourth is the research and development costs. We are back to immediate write-offs. So if you spend money building or improving products, software, or processes within the US, you can once again deduct those domestic R&D costs right away instead of spreading them out over years. That frees up cash now. It encourages innovation. Some small businesses even have options to clean up prior years that got spread out. So it may be worth going back and seeing if you can amend some of your prior returns under these provisions. So here's a simple planning idea for that. Build a one-pager of your 2022 through your 2024 research and development outlays. So people, prototypes, testing costs, and ask whether amending makes sense for refunds versus accelerating what's left into 2025 or 2026. 5, 1099 thresholds have changed. So this has been something that's been a gripe of people for years. You know, the threshold for 1099 MISC, miscellaneous, or 1099 non-employee compensation, NEC, has been stuck at $600 for quite some time. So flat $600, if you pay out a contractor, you've got to be tracking that and make sure you provide them a 1099 at the end of the year. And $600 is a pretty low threshold. Well, that's now been changed up to $2,000. So that doesn't change your internal controls. You still need to get a W-9 and you still need to track all of your vendor payments accurately to make sure that if you hit that $2,000 threshold, you are still submitting a 1099. But the threshold is a little higher now and it's indexed for inflation now. So just something to keep in mind. Don't change your controls. And if you have bad controls in place, put some new ones in there. The SALT deduction cap has gotten bigger. So state and local taxes. This was a big point of contention, especially among states with higher local taxes, state and local taxes. So you think New York, California, things like that. Under the Tax Cuts and Jobs Act, this was limited to $10,000. So if you itemized deductions, you were stuck at this $10,000 limit. That has now been raised to $40,000. And in conjunction with that, and this is a huge planning point, the pass-through entity tax option is still there. So this has been a workaround that a lot of states put into place because of the Tax Cuts and Job Act, where your pass-through entity could pay your state and local taxes on your behalf, get a deduction for it, and then you on your personal state return would get a credit for it. Now, it's dependent state by state, but it's something really worth looking into because since the PTED option is now still available, now you've got a dual planning opportunity. You can have your pass through pay a certain amount of the state taxes, and you can also put some on your personal return if you itemize. So that amount has been changed to $40,000 with the One Big Beautiful Bill Act from $10,000. So make sure you're looking at that. If you itemize, that is a must do. You must plan for this. Seven, the estate and gift taxes. There is a higher lifetime exemption. So starting in January, on January 1st, 2026, the federal estate gift and generation skipping tax exemptions are 15 million per person. So about 30 million per couple, indexed over time, and the top rate stays 40%. Who this affects most? Owners with growing businesses or appreciating real estate who could cross that line later. So if you have a lot of appreciating assets that are eventually going to be passed down to your heirs, you need to be aware of this. So planning on doing with this, even if you're under the threshold now, consider different moves like funding trusts or freezing values so that future growth happens outside your taxable estate. Check your state rules. Some kick in far lower than the federal rules do. Number eight, the clean energy saving credits timelines have been moved up. So some home and business energy credits for certain home upgrades, charging equipment, commercial efficiency incentives have now phased out or terminate earlier than expected. Your placed in service or start of construction date can be the make or break for if you can claim the credit or not. So this affects builders, landlords, businesses planning energy upgrades, or homeowners considering improvements. So before you sign on that dotted line for an energy efficient update, make sure you confirm that the dates still qualify so that you can take advantage of that credit. Okay. Number nine, this is another big one. Qualified small business stock exclusion, section 1202. You've got bigger potential exclusions and shorter waits. So for new qualified small business stock issued after July 4th of 2025, the One Big Beautiful Bill Act raises limits and adds partial exclusions at shorter holding periods. So that can make selling a successful C Corp more tax efficient for founders and early investors. Some of the thresholds to know. The per issuer cap steps up to $15 million for qualifying new stock. Older stock keeps its old cap. The company size test increases from 50 million to 75 million in gross assets at issuance. So this brings in a lot more people, a lot more companies that otherwise may not have qualified for this. There's also a shorter holding period where there's partial exclusions at 3 and 4 years, and it keeps the 100% exclusion at the 5+ years. So if you're holding stock in these small businesses for more than 5 years, you still get the 100% exclusion. So this affects founders, early employees with equity, and angel and seed investors that invest in qualifying C corporations. So if you are planning to incorporate or raise capital, make sure you're comparing your C Corp versus an S Corp tax structure in light of these, the qualified small business stock exclusion. You really need to run the numbers and make sure which entity type is going to be right for you. But I can tell you, if you're going to raise capital and you're going to eventually go public, go the C Corp route. If you're going to stay small, look at the S Corp route depending on what your growth plans are over the future. So 10, new personal write-offs tied to work, the tips and overtime deduction. Again, we made a video going a little more in depth into this, so check them out. We have one for tips, we have one for overtime. That simply means if you're in a tipped position or in 2025, and this is not permanent. This goes to 2028. So you get a tip deduction of $25,000 per year. This phases out at about $150,000 of income, double that if you're a joint filer. If you're getting tip income, you get to deduct part of that off of your tax return. Same thing with overtime. Up to $12,500 of overtime gets a deduction. For tips and overtime, you still have to pay Social Security and Medicare taxes. So this only applies to income taxes. So this affects your restaurants, your hospitality people, retail, or any employer managing a lot of overtime. So if you're an employer, make sure your payroll systems flag and report these amounts so the workers get the benefit. And if you're a worker, make sure you're double checking your pay stubs, your end of year amounts to make sure that they're accurate, because this is going to be one of those things that it's going to have some growing pains in that first year. Anyway, so those are 10 things that are going to affect you with the One Big Beautiful Bill Act. And let's do a bonus one real quick. Let's talk about charitable giving. Two quick numbers that I want to talk about. So starting in 2026, itemizers are going to face a smaller floor of 0.5% of AGI before donations start counting, and corporations get 1%. Now, here's the most exciting part. So if you're a non-itemizer and you're a charitable giver, you get to take an above the line charitable deduction. So that means even if you don't itemize, you get to take advantage of your charitable deductions. So you get up to $1,000 single, $2,000 if you file jointly. But note that gifts to donor advised funds and most private foundations don't qualify. So imagine, just for safe rule of thumb, if you're donating cash to a 501c3, it's going to count for the above the line deduction. All right, guys, that's it. That was the high-level tour of the One Big Beautiful Bill Act. In the future, we are going to do some more deep dives onto these. We're going to do some different planning videos for some different provisions that aren't necessarily One Big Beautiful Bill Act, but we will come back to these. So the theme across the board for this video is bigger immediate write-offs, higher caps for things, and clearer long-term rules, but with key thresholds and dates you don't want to miss. So make sure when you go to your tax pro this year, you go and bring them, say, what are 3 moves with the One Big Beautiful Act that matter most for me and my business this year, or for my personal tax return? So make sure that they're caught up on everything. If you need a good CPA firm, High Impact CPA is currently taking on new clients. So please feel free to reach out anytime. I'm going to leave some contact info in the comments of this video, in the description. We do 30-minute free consultation calls. So reach out if you've got questions. We'd love to see what we can do for you, make your life a little easier, save you taxes, increase your profits, increase your cash flows, and just make life a little bit better. All right. Thanks, everyone. Take care.